Take your attention back to this level here. This is our breaker. High, low, higher high, down close candle. Extend that out in time. You can see how we work that here. The body's respecting that. Yeah, we had that wick. And we had this here, trading on Thursday, shoots up into it, and then resistance. Look at the body's respecting that. And then one more time here. Then we sell off. And all this in here we'll look at on the lower time frame and revisit a PD array that I taught in recent months, and we'll see it again materialize in this area here. 15-minute time frame on pound dollar. Again, this is that 60-minute breaker, bearish breaker, and obviously the bearish order block here, last up close candle. Hits the bearish order block inside of a 60-minute breaker. We have a nice little optimal trade entry here. Not the right time of day, but nonetheless, you can see it's supporting the idea of that bearish breaker. Next day on non-farm payroll, lots of sloppiness in London. See that? And then we have that run up on the non-farm payroll. Doesn't really take out the highs. Does break out above the rejection block, which is the highest up close in the day and in London. So we have that there. And then it breaks down. Then it gets sloppy in here. Lots of run lower, come all the way back. The next candle, we rally up one more time and trade back down. Then we have nice clean delivery of a candle on the downside there. And we run back up here, which is redelivered rebalance. Inside of this range, okay, it works out its noise, if you will. I'm saying that with my tongue in cheek. There's no noise here, but we'll take a look at that in a moment closer. But it drops aggressively, takes out the sell side liquidity there, and then closes right on that same old low. But I'm going to zoom in here and give you a little bit of a explanation as to what's going on. Non-farm payroll numbers hits the market here. The algorithm runs up, getting everybody thinking it's going to go higher, so they chase it. Then the market enters a sell program. It breaks lower, and after it takes this big run here to the low, comes all the way back up and snaps back here to a close. The next candle it opens, trades higher, and then goes lower. And then the next candle here, we roll all the way down through this low. The lows that I'm concerned with is this one right there, and then the high is this candle here, because we've exited all of this range where we went down, came back up, and started a new pass here, and then went lower than that low there. This high and this low, those are your real imbalance points. All of this, and all of this, and in this price action, all of that muddy water gets cleared up if you just go right back to the candle right before all of this mess, and you use the candle's high that took out the low that did all that back and forth price action. So by doing that, anchoring it to the opening price and the low price here, you'll get 139.07 and 4 pipettes. Notice I have this little area down here highlighted. You can go to your forex.com pound dollar chart on the 15-minute time frame. Put your cursor or your mouse right on this candle right there. Okay? When you do that, what's going to occur is you're going to see with that candle, notice what the high is up here. See that high? Is that any different than the midpoint here? No. It's perfectly delivered. This is redelivered rebalance. This is one of those signatures that really highlights the fact that these markets are not random. They're not controlled by buying and selling pressure. It's not any of those other things. I'm taking you right to the core of why these markets deliver the way they do. It's not anything other than what I'm telling you it is. Okay? If it were anything other than what I'm telling you, these signatures would not exist in price. And because they exist, and it's so perfect, it begs the question, okay, if that's random price action that takes it right up to here, why would anyone that would not know what I'm teaching you here, why would they know to sell right there at that level when there's nearly nothing over here to warrant that level, to be that precise? And this is exactly what I've taught you in the beginning when I first introduced redelivered rebalance. So when you see things like this, they're hallmarks to controlled delivery and complete manipulation of the currency, which highlights the underlying premise to why you're learning this whole idea of reading price action. Because if the algorithm is referring to these price points, as I'm teaching you here, there's no reason for you to look at other things. This takes you to the heart of what the market's doing, and it gives you an X-ray view, even in a high volatile condition like non-farm payroll. Now, obviously, we're an hour after non-farm payroll, so 30 minutes minimum after non-farm payroll. I think if you're going to ever engage, give it at least 30 minutes. That way it works out. The initial run gets the sentiment in play, and usually the public's on the wrong side of the marketplace. And you can see it in here. It delivers exactly how I teach Redelivered Rebalance. This is the consequent encroachment of that range. Again, the low. And then we have this big messy candle. Okay, forget that candle even exists. Just ignore it. And then you have this candle here. Forget that candle even exists as well. Just think of it as, from this candle here, we had a range from that low to that candle's opening. There it is. It's done. You've completely got rid of all of this quote-unquote noise. Okay, that noise is the manipulation. We don't look at it as noise. We look at it as manipulation. It gets the market participants confused. Anyone that's seen this short-term high taken out, if they were short, they're probably stopped out and they're not going to try to get back in. Anyone that wants to be a buyer here on the volatility breakout, well, they get in just to get destroyed. So anyone watching on the sidelines, they have no idea what's going on because it's going back and forth for 30 minutes. And then finally, this little run up in here, right to a level I've taught you, precision, not one pipette off, not under, not over, right to the pip. Can't get any better. To the pipette even. That number 4 right there, that's a pipette. That's not even a full pip in price fluctuation. And it's delivered perfectly. So it's important for you to go back and look at high volatility market drivers that are coming out in the marketplace, like FOMC, rate announcements, the non-farm payroll, obviously, as we're illustrating it here, and any big news driver that creates a lot of whipsaw initially. If you go back and look at your price data and you see these whipsaw price actions and where it runs down, creates a big wick and trades back up here, and it overlaps that whole run and leaves that range, that candle, use that high, find the one candle low prior to the big, back and forth price action candle, and just erase all of that from your mind. Don't even look at it like it's even there. Forget it. And this is what the algorithm's doing. It's ignoring this candle. It's ignoring this candle because it's already did its work here. The algorithm starts to run higher, not because of buyers. Smart money traders, okay, they're not buying price to send it up to knock out these stops. That's not what's going on. You hear everybody else here that thinks they understand what I'm teaching, and they'll say, yeah, the buyers push price up. That's not what's going on. The algorithm is simply expanding and moving higher, offering price higher, no matter how many people are buying. Every person that gets basically pushed out of the marketplace, these buy stops, as it goes deeper above this, it's forcing that liquidity into the marketplace. It's not willing buyers that want to buy because they think it's going to go up. It's not always buyers chasing price because they want to be a buyer. They're squeezing on this high here. The algorithm is doing that. It's only running up to put pressure on this to induce a flood of buyers into the marketplace. So that way smart money can have willing participants. There's liquidity entering the marketplace as a result of that. So it's not buying and selling pressure. It's manipulation and repricing. That's what's going on. But nobody wants to hear it described as I'm teaching it because it gives you the clarity that you really don't have an advantage in this marketplace unless you understand what you're learning here. Once you understand that, it strips away, or at least it will over time, strips away all of the uncertainty and fear about the quote-unquote random market, which doesn't exist. There's no randomness. And because they're doing these things over and over and over again, they repeat. Why? Because the algorithm is not evolving. The algorithm is not evolving. It's been doing the same thing. In fact, this is the same thing that floor traders would do. They just go right back to the time interval prior to this big whipsaw, what's that low? Right there. And where do we open up on a new candle after we pass through that low? That's what we're doing. Okay? So the algorithm, because it's taken the logic that has always been in making markets and how price is delivered, all these little intricate little things that make price behave the way it does, not because of buying and sellers, because if it was just buying and selling pressure, if it was really supply and demand factors, it would not be this precise all the time.